In this video, we're going to cover a substantial amount of information. We're going to start with a critical U-turn that's happening within the Federal Reserve. Then, we'll touch on Bed Bath & Beyond and their impending bankruptcy. We'll look at Michael Burry's latest warning. We'll touch on the new gold and ARK Invest's latest research letter. We have a lot to cover, so let's get started. First, the Federal Reserve is a very important institution because obviously their hiking of interest rates has led to the most predicted recession ever in the histories of recession. It is why we are all experiencing as much pain as we are, unless of course you're shorting and celebrating with champagne, because the market has been trending straight down, and the real estate market is following suit with about a 7-month lag. The real estate market seems to have peaked around May, and the stock market seems to have peaked in November of 2021, and both of them continue to trend down, though there is hope. But remember, hope is not an investing strategy. And what I'd like to do is look at what the Philadelphia Fed just said in terms of a potential U-turn at the Fed. And this is not the kind of U-turn you're thinking of. It's not the kind of, oh, let's slash rates. The bond market is already pricing that in. The bond market is already pricing in 1.7% of rate cuts by the end of 2023 and 500 basis points or 5% of rate cuts by the end of this cut cycle, which will probably take 2 or 3 years once rate cuts begin. In other words, yes, we are probably going back to zero, but we don't have to agree on what the bond market is projecting right now. What we want to do is start looking at where are cracks at the Federal Reserve. And the Philadelphia Fed just gave us an example. Take a look at this. Pat Hawker from the Philadelphia Fed just stated that hard data can be useful, like employment growth numbers and GDP. However, there is a big issue with using hard data exclusively, or worse, overemphasizing hard data when you should not. Consider what's happening in our economy right now. The Federal Reserve, in my opinion, is overemphasizing the hard data we're getting from the labor reports, which suggests that somehow we're creating millions of jobs via the Bureau of Labor Statistics labor reports. That hard data is actually leading Jerome Powell and the Federal Reserve to be more aggressive. In fact, the Philadelphia Fed just a few weeks ago, let's tangent for a moment here on this. This might sound familiar, but it's important to remind you that the Philadelphia Fed is actually the one that has started waving the red flag, suggesting, wait a minute, the hard data might be wrong. We might actually be overstating how many jobs the U.S. economy is creating in just one quarter of 2022 by 1 million. That's because we're seeing less full-time jobs, more part-time jobs, and more multi-jobs, leading to the indicators that, at a glance, labor looks like it's so strong. But really what you're seeing are cracks. You're starting to see people have to take multiple jobs because of the most insane inflation we've seen in the last 40 years. But why do we in part have some of the most insane inflation in the last 40 years? Well, because the Federal Reserve in Philadelphia thinks that there may have been an overemphasis on hard data that actually led to the inflation we're seeing today. Look at this. An overemphasis, says Pat Hawker, candidly, an overemphasis on hard data like GDP and employment growth can lead to policy errors. Hard data last year suggested to us that inflation would be transitory. That was obviously a big mistake. But what was soft data telling us last year? Well, Pat Hawker tells us. Soft data said that we were actually seeing rising prices that were proving to be much more persistent than the Fed had expected. Now, had the Fed listened to the soft data then, they would have started raising rates and stopped the money printing sooner, potentially preventing some of the most insane inflation that we had to deal with in 2022, rising to nearly 10% in America and over 11% in Europe, and over 80% in Turkey. But that's a topic for a different video. What is the soft data telling us today? Remember, soft data are survey results. That is ISM surveys, S&P PMI surveys, expectations from the University of Michigan, rent surveys, labor surveys. I kind of scribbled this one over here. All of them are pointing to a deepening recession. All of them. Now, yes, there is still mixed data. And Pat Hawker in this report talks about how the data is mixed. And that's because we are still getting some hard data that is saying maybe the Fed needs to be a little tougher, and some soft data that actually says, hiring's still tough, still seeing that we have to pay people more to come work. But are those potentially just more blue-collar workers rather than white-collar workers? And what difference does that make for our economy? Well, let's pause for a moment before we get to this Michael Burry warning, which relates exactly to this question, and ask ourselves, if we're starting to see cracks at the Federal Reserve, where the Fed is starting to say, wait a minute, maybe we are being too aggressively focused on the hard data, we might actually prepare for a softer Jerome Powell come Feb 1, the next FOMC meeting. There's a reason the bond market is not only pricing in just a 25 basis point hike at the next meeting, but a pause no later than June and cuts by the end of the year. It's because the bond market is paying more attention. The big money, the smart money, is paying more attention to these leading indicators, which suggest the Fed is going too far. And the Philadelphia Fed is realizing the hard data is starting to look misleading, and it was misleading last year, and it's time to start paying attention to what's actually happening in the economy. This is a great thing. But now we need to talk about Michael Burry's latest warning. Right after, of course, I mentioned that I thank you for being here. Thank you for watching this video. And if you like this longer form video, let me know in the comments down below. I'm going to pay specific attention to the comments on this video because this is a longer form video versus the usual 8 to 12, 14-minute video. This video obviously a lot longer with multiple different topics that are connected with obviously an emphasis on economic news. Let me know in the comments down below if you like this or you prefer the shorter style videos. Michael Burry believes that we are in a white-collar jobs bubble. Now, this is more fascinating than the announcement that the next coupon code will be expiring January 30th for the programs on Building Your Wealth linked down below. Yes, you can take advantage of that coupon code link down below for any of the programs where we conduct private live streams together. I'm actually thinking about moving those back right up to the market open live stream. We do a live stream every day the market is open. Course members really enjoy those. We do fundamental analysis, technical analysis, Q&A together, and a big emphasis right now not only on fundamentals, but also on real estate investing. So bring your real estate questions as well, because there is going to be a huge opportunity to get value in real estate coming up soon. So get educated, check out the 0 to Millionaire Real Estate Investing course, check out the shadowing options for coming with me on a private jet as we explore real estate and we'll document the journey. We'll have you have the opportunity to ask any questions you'd like in person, follow me along, grab a drink with us at the end of the day, and as always, check out the links down below for all of the information. Okay, so Michael Burry talks about a white-collar employment bubble bursting right before our eyes. And the longer it takes for the redundancy to disappear, the more permanent the decline in employment will be. Work from home will, in time, be seen as the culprit. I see a bifurcated labor market developing as unskilled and semi-skilled workers remain in short supply, but white-collar workers, having proven their redundancy during COVID, will find gross excess in the labor market, pressuring wages at the end. Now, this is absolutely fascinating because it directly corresponds to what Pat Hawker is telling us. Pat Hawker and the Philadelphia Fed are highlighting that the hard data suggesting that wages are rising are not paying attention to the fact that it's blue-collar work that's actually rising, not white-collar work. It's blue-collar workers, it's manufacturing, it's fulfillment. These sectors are seeing wage growth. It's accommodations, it's services for travel, airlines. That's where we see a lack of employment. And a white-collar bubble bursting will be very likely to lead to a decline in wages. That means disinflation in goods. A disinflationary environment in housing could potentially be combined with a disinflationary environment for wages. Now, this is actually where Michael Burry and I begin to differ, because Michael Burry then suggests that we are going to see rapid deflation, but because the Fed is going to rapidly U-turn and start printing money again, we are going to create a second wave of inflation, and this entire disaster we've gone through will all repeat itself. So we actually align with massive deflation coming, completely agree. I differ with Burry personally, in that I don't believe we're going to see massive inflation again, just like we did not see massive inflation again during the 2008 and 2019 era. And I especially don't believe so as we actually, in my opinion, re-globalize, where we actually have produced some of the most efficient supply chains in the world. And companies are actually scaling back on manufacturing, but they have the capacity to rapidly expand with machinery and the factories they've built, which suggests that when we actually reopen, when China reopens, when we as Americans start spending more in the next bull market, what happens? These companies are already hopefully ready to fulfill in a high demand environment because they suffered through 2021 where they could not. They were not prepared for that sort of demand. They never want to be in that position again. I believe that sort of re-globalizing will keep inflation low. But let's stick to some commentary from Michael Burry at the moment. And could he potentially be right? We'll consider the following. Goldman Sachs is laying off 3,200 employees. That amounts to about 6.5% of their workforce. That's a little less than the 8% they were predicting, but it's still a big cut in finance. White-collar jobs. And that's actually a big deal for real estate as well, because if you're focusing on white-collar jobs as potential tenants, and those are the ones getting laid off, you have to be careful for your real estate startup, which happens to be called HouseHack. If you're an accredited investor, make sure to check out HouseHack via the link down below. IPO issuance has dropped 94% from last year. Goldman Sachs scaling back on consumer banking. Coinbase slashing 20% of their workforce, cutting a fifth of their workers. That's after an 18% reduction in June. More white-collar jobs evaporating. Expenses are being cut at white-collar companies. Microsoft is freezing the expansion of offices in Seattle, as I learned in my real estate explorations yesterday in person. Amazon cutting over 18,000 jobs, scaling back on a lot of corporate and recruiting jobs, white-collar jobs. Again, having admitted to hiring too rapidly during the pandemic, which reiterates what Michael Burry suggests, that white-collar jobs are proving to have been hired in substantial redundancy. That is, we have too many people working in the corporate offices. His warning is aligning with what we're seeing. Salesforce cutting 10% of its personnel, more than 7,000 employees. And the co-CEO saying they're taking a more measured approach in business expenses. This is a red flag for businesses that rely on cloud services. Because think about it. As you look at cloud companies growing 30% year over year, what do cloud companies rely on? They rely on seats, subscriptions for more white-collar employees. But if we're actually shrinking the white-collar workforce, software as a services industries could start shrinking. That's a red flag. But it's also a red flag for companies that rely on white-collar consumers. I hate to say it, but your average buyer of a Tesla is a white-collar purchaser. It's a red flag. Tesla's got to get less expensive vehicles to keep sales moving. And that's exactly what we're seeing at Tesla. But this is not to suggest that all of the excess we are seeing is exclusively in white collar. Consider, for example, the disaster that's happening at Bed Bath & Beyond. Bed Bath & Beyond is a fantastic example of a company that has failed in its corporate management and guess what? Did not take the warnings of JCPenney. Consider this. The CEO of Bed Bath & Beyond completely failed to realize that removing coupons was a fatal mistake for retail. In 2012, CEO Ron Johnson of JCPenney came from Apple, a store that had limited promotions, and but also caters to a higher income individual with a higher margin product, and moved from Apple running stores to trying to run stores at JCPenney. Ron Johnson focused on everyday promotions and everyday good pricing and eliminated constant couponing, eliminated MSRP pricing and then showing discounts underneath that, and also eliminated psychological pricing like ending pricing at $9.99 and just going to whole numbers like $10. The result of removing people's perception of value that they were getting a discount off of MSRP, which we all know is an inflated price anyway, but yet people still go into Macy's and go, wow, I'm getting 30% off MSRP and I can stack that with my Macy's credit card benefits and I feel like I'm getting 45% off MSRP. I feel like I'm winning. Well, when you remove that psychology from people, what happens? Sales plummet. JCPenney saw their sales plummet $3.3 billion over 15% in just 1 year, from growth to losses. Losses ramping up so substantially that CEO was fired within a year. And so The Bed Bath & Beyond CEO apparently didn't get it. That one of the reasons people actually liked going to Bed Bath & Beyond was because, well, A, hopefully they had stuff in stock, but B, those white and blue mailers that gave you 20% off were a great opportunity to induce sales. The CEO didn't think so. He thought, no, we should focus on more niche brands, and we should focus on getting rid of couponing, and let's just focus on brands that we can promote as higher value and higher margin. So what happened? Sales plummeted so much so that suppliers actually refused to provide supply to Bed Bath & Beyond, to where 43% of Bed Bath & Beyond's product was out of stock in October, right before critical Black Friday sales. So what happened now? Well, now we're in a situation where activist investors like Ryan Cohen have dumped their positions. Sales are down 33% year over year. The stock is down 90%. However, it has rallied this week. They're running out of cash substantially for the next quarter. They're reducing white-collar jobs by laying off the corporate sector and closing 150 stores nationwide. Shopper visits across the chain are down 26.5%, and now they're considering potentially a Chapter 11 reorganization, bankruptcy filing. Personally, I think based on the latest number, they may as well just, numbers at least from their financials, they may as well consider a Chapter 7 because the numbers just are not good. This right here is the Bed Bath & Beyond latest earnings filing, and what I'd like you to pay attention to is the massive declines that we're seeing in assets and revenues. Let's start with revenues. Look at net sales here. Last year, net sales sitting at 1.87 billion. This year, same period, down to 1.2 billion. Unfortunately, last year when they had 1.8 billion in sales, they were already losing money. $86 million gone. Now they've expanded that operating loss to $450 million. This is a company that is burning money. The more product they sell, the more they are losing money. Now, that mostly is because, even though they still have a gross profit, they are too bloated with their SG&A expenses. SG&A alone being twice their gross profit. So the more this company operates, the more this company is trending towards bankruptcy. You don't have to go far to understand that. Look at their balance sheet. Understand that inventories are going to get washed down, at least some part, by gift card liabilities that they have. But let's just focus on hard cash right now, because we already know that as a going concern, this company, even as it sells inventory, is burning more cash on SG&A than they actually get from profit from inventory. So what I'm going to do is I'm going to ignore looking at inventories for a moment, and I'm going to look at actual cash they have, $153 million. Now I'm going to look at actual cash outlays they have over the next 12 months. Oh goodness, accounts payable and accrued expenses, which are like paying for the inventories they have. These are paying suppliers to get new inventory so they can actually fill up the shelves appropriately to make sure they can keep attracting customers. $1 billion of current liabilities. They only have $153 million of cash. They have to sell product just to survive. But every quarter they sell product, they lose more money because of their operations being twice as bloated as their gross profit. This company is a walking zombie. And this was why, when you look at the cash flow statement, what are they doing to actually survive? They're not surviving with operations. We already know that because they're losing money substantially from operations. Cash flow statements shows a burn of $300 million. So anybody looking at, well, they have inventory, Kevin, why aren't you using that? They're burning money on operations, $300 million in the last quarter. But what do we have from financing to keep them afloat? Oh dear, okay, they borrowed another $375 million and they did an at-the-market stock offering, diluting your shareholder interest by $119 million just to stay alive, increasing their cash position by $59 million strictly by borrowing and issuing cash. Had they not borrowed and issued, or stock that is, had they not borrowed and issued stock, this company would have been out of money. They don't have enough money to survive. This is not the company to make a fundamental investment in, and it's certainly not the company to speculate on believing that it is going to be the next Hertz. Remember that Hertz, when they filed for bankruptcy, skyrocketed. But the reason Hertz skyrocketed when they filed for bankruptcy is because in bankruptcy, they had multiple bidders for the used car company. Why? Because used cars were skyrocketing in value. The product they had, their inventories, was becoming more valuable, not less. Bed Bath & Beyond's inventory is becoming less valuable, not more valuable. The company's liabilities in a liquidity crunch, in a recession, are becoming more damaging, not less. Hertz was a special scenario, but however, it has led to a meme movement in every time a company is about to go bankrupt, like the Revlon Group. What do you end up having? You end up having companies that skyrocket. You look at Revlon, and Revlon fell to about $4, $2 to $4 right as they filed for bankruptcy. And they rightfully filed for bankruptcy. Their financials were a disaster. I warned of investing in this company in a private course member live stream as we did a deep dive fundamental analysis on this company as it was running to $7, $8, $9. And I said, this is pure momentum and it's not going to last. The fundamentals will shine through on Revlon. And sure enough, they did. The stock that was $10 is now 50 cents. The same is true of Bed Bath & Beyond. These rallies are driven by temporary momentum purchasing, and if you don't get out, you're going to be left holding the bag, a stock that will probably be worth well under $1. I would exercise extreme caution at a company like Bed Bath & Beyond. That's not to say you can't play the meme game, but just zoom out at the chart, and you see this company only goes up when volume goes up. And otherwise, it bleeds down and lower and lower and lower. You don't even actually have to look at the fundamentals to tell you Bed Bath & Beyond is a complete disaster. But what is not a disaster, in my opinion, is the future of the chips industry. Now, I have been a big proponent of actually investing in the crash of chip stocks, AMD, NVIDIA, Taiwan Semiconductors. I actually believe these companies have ridiculous purchasing and pricing power. Don't get me wrong. In a recession, everyone shrinks. Everything shrinks, and it sucks. Nobody wants their PP to shrink. We want pricing power to go up. But companies that actually have substantially high margins, like NVIDIA, AMD, Taiwan Semiconductors as a manufacturer, in my opinion, fantastic. I personally think a lot of individuals should consider investing in potentially actively managed ETFs that have high exposure to chips. I think chips are going to be explosive over the next 10 years. And the reason I like actively managed ETFs is because of the massive tax benefits of holding an ETF ticker rather than holding individual stocks. So that way, when it's time for an active manager to rebalance, they could do so trading stocks within the ETF without passing on massive capital gains to you when they sell a stock at a large gain that is run above and out of balance of the others. It's a fantastic benefit of an actively managed ETF. And I personally think pricing power style ETFs are the ones to look for. And what I think is absolutely remarkable, something that a lot of us are not paying attention to, is this idea that look at over the next 10 years, the amount of money in the United States that is being announced for manufacturing capacity. We are looking at $186.6 billion. To put that into perspective of how much money is getting thrown into the chip industry, I want you to think that an expensive gigafactory for Tesla, like the Northeast Mexico one that is expected to be built, will probably first see an expense of about $4 to $5 billion and maybe up to $9 billion in the long term. Now, what I want you to think of is how 186 is 20 of those. The chips industry is expected to explode, and the United States wants to fight, I hate to say it, but Taiwan, South Korea, and China in explosive chip growth. The United States and politicians are jumping at the opportunity to expand manufacturing for chips in the United States. That's why Joe Biden, Biden administration, and Congress, in a bipartisan manner, passed the CHIPS Act this year. However, Taiwan Semiconductors does give a warning. They say that it's still more expensive, sometimes 50% more expensive, to develop chips in the United States than it is to develop and manufacture them in the Asia Pacific region. Now, that, in my opinion, gives me a reason for diversifying my chip investments into not just American companies like, let's say, Intel, who not only designs chips but manufactures them, but stick with companies like NVIDIA and AMD that actually have strong exposure to the Asia-Pacific region and use manufacturers like Taiwan Semiconductors or Samsung to take advantage of their scale and higher margins to continue to deliver a product at lower prices that more people can buy. That's a form of pricing power. Deliver more product while manufacturing it as efficiently as possible, and do so more while cannibalizing your competition, especially in a recession. Now, this particular Wall Street Journal article suggests that oil was the foundation of America over the last 100 years, but they go on to say that the semiconductor industry is expected to be the new oil going forward. They give examples of how there are now so many more chips in everything we use than ever before. Like, for example, a 40-cent chip that left 40,000 Ford trucks stranded in production because that 40-cent chip for windshield wipers was in short supply. In my opinion, the Wall Street Journal here, it makes it very clear that the United States is lagging to China and Taiwan and South Korea. But as an investor, I look at the broad chips industry and I look at companies that are taking advantage of what is happening not only in US investments. Think about how Taiwan Semiconductors is coming to Arizona and building a massive plant here, but also in Asia. And how can you get that sort of exposure? Again, in my opinion, really look at companies like NVIDIA, Taiwan Semiconductors, and AMD. Now we've got to talk about Cathie Wood. She recently wrote an investment piece that was very optimistic on Roku. And I'm going to dive into some research that we did with course members in our course member live stream. Remember, there is a coupon code expiring soon. Make sure to take advantage of that by January 30th. That's coming up soon. But Roku, in my opinion, while all these ships and seas may rise as the rising tides of the stock market go up, Roku's not exactly my favorite play. I'm going to show you here why. Take a look at this. We do see 15% year-over-year growth in connected TV spending on Roku over the last year, which is great, 15%. However, that's actually a deceleration of almost half from the prior 9-month period. That's not great. We went from 25.8% growth to 15% year-over-year growth. That's dangerous, in my opinion, for a company that is now losing money. Last year, we were not losing money at Roku, and this year, we're losing $146.9 million. As look at this, research and development nearly doubled, but sales and marketing did. Well, also actually nearly doubled. Both of these nearly doubled. And this is crazy because if your sales and marketing expenses are doubling, but you're only increasing revenue by 15%, you've got yourself a bit of a problem. The TradeDesk increased their advertising 44% over the same period, and revenues increased 30%. In my opinion, the TradeDesk is a substantially better investment than Roku. I've also come to question the investment logic that some of the managers at Roku use when they suggest they want to get into TV manufacturing. Why would you get into something that has virtually no margin? There is no pricing power in TVs. I would never invest in TVs, but I would invest in a company like the TradeDesk, which helps organize advertising on connected TVs and works with companies like Disney. That's big, especially since Disney is expected to be more of an advertising player than even YouTube, and a big competitor to Netflix, who currently does use Microsoft for their advertising experiment. Still not sure where that'll go, but we'll see. Now, I do mention here that their stock-based compensation did explode quite a bit. But so there is a potential for a little bit of a one-time move in some of these numbers at Roku, but they still make me nervous nonetheless, especially since why are we spending so much potentially on stock-based compensation for sales and administration and research and dev and advertising when revenues are only growing at a 15% year-over-year clip for a company that's now losing money, which means you have an infinite PE ratio during a recession. It makes me nervous, and it doesn't make me very excited. So there you have my Saturday piece. I hope you have found this super insightful. Let me know if you like this sort of longer form, connecting the dots, a video versus sort of the more individual piece videos that are potentially a little bit shorter. Hopefully this is a little bit more podcastable and something you can enjoy connected together. And hopefully it provides an extreme amount of value. Let me know in the comments down below. Thanks for watching. Check out the programs. We'll see you soon. Goodbye.